Welcome to the Wealth Secrets channel. Let me ask you a quick question. Have you ever made any mistakes while you invest? What is the most significant investment mistake that you have ever made and why? You may say, maybe I'm a beginner in the investment field and that's why I made the mistake. However, what if I tell you that even Charlie Munger, who is vice chairman of Berkshire Hathaway, still made his investment mistake, although he is well experienced in the investment field, as well as Warren Buffett. What would you feel about this news? Actually, it's natural and easy to make mistakes along the way as part of the experience. Keep watching this video until the end because you're going to know the common error that all investors make, including billionaires Charlie Munger and Warren Buffett. Why is a mistake and how you can avoid these three parts. Before kicking off, if you want to know what kind of investment mistake Charlie and Warren have made, don't hesitate to hit the like button now. Turn on the notification bell to be notified every time we upload one. Most importantly, if you want to watch more videos like this, then hit the subscribe button now. If you are all set, then let's get started. Part number 1. What is the common mistake all investors make? The common mistake all investors make, including Charlie Munger, is letting their emotions get in the way of their investment decisions. Human is emotional beings, so it's common that a lot of investors make this mistake, including Charlie Munger. Charlie Munger was fascinated by Alibaba's online position within the Chinese e-commerce market, and he didn't realize that any Chinese enterprise's stock price can be largely affected by the government, especially after Jack Ma gave a criticizing speech related to the Chinese authorities. Investors often need to take the time to properly assess their goals and risk tolerance before jumping into the market. They might understand the local culture, just like Charlie Munger's issue, read a few books, listen to a few podcasts, or watch a few YouTube videos, then dive right in, assuming they are prepared to invest wisely. Also, investors should be sure to understand the personal goals before investing in anything. It is also essential to clearly understand what risks you are willing to take and how you plan to manage them. Investing without taking the time to think through your strategy is a mistake that can cost you money and time. Feeling fear or greed when investing is natural, but allowing these emotions to guide your decisions can lead to poor outcomes. Part number 2. Why is this a mistake? There are a few reasons why letting your emotions guide your investment decisions is a mistake. First and foremost, it can lead to impulsive or rash decisions. If you're confident, you may be tempted to sell your investments too early, and it is very common. Just like Warren Buffett made this kind of mistake as well. Anyone whose preference is buy low, sell high may also be likely to sell the stock since the stock price increased from $70.25 to $63 already. Not to mention, nobody knows when is the highest point. Additionally, emotions can cloud our judgment and make it difficult to see things objectively. When you are emotionally invested in a particular investment, you may be more likely to overlook its flaws. This can lead to making poor investment choices and potentially losing money. In short, regarding investing, although it is easier said than done, we need to bear in mind that expect the unexpected and not get too emotional when things don't go as planned. Before going to the next part of how can you avoid letting your emotions guide your investment decisions, if you feel like you've gotten the value so far, then make sure to smash the subscribe button and the like button. Final part, how can you mitigate the influence? There are 4 steps you can take to avoid letting your emotions guide your investment decisions. Number 1, develop a long-term investment plan. Having a clear investment plan can help you stay focused on your financial goals. A long-term investment plan should be based on your financial goals and the amount of risk you're willing to take on. It should specify how much you can save and invest, the types of investments you feel comfortable with, the specific assets you want to own, and the amount of money you want to have in each account. The more you can save, the more you can invest. If you want to know more about how to boost your income so that you can save more money to invest, or how to make money online, then feel free to click the links down below after finishing watching this video. Once you've identified your goals, it's time to choose the suitable investments for your plan. Many investments are available, including stocks, bonds, mutual funds, and ETFs. Consider both your risk tolerance and time frame when choosing investments, and make sure to diversify your investment portfolio in order to mitigate the risk. Finally, once you have chosen the suitable investments for your plan, you must monitor your portfolio regularly and ensure they align with your goals. They will help you stay on track and ensure you are doing everything correctly. By creating a long-term investment plan and sticking to it, you can avoid the biggest mistake all investors make: having no plan at all. With a solid plan in place, you can rest assured knowing that your money is working hard for you and helping you reach your financial goals. Number 2, seek out unbiased information. It is important to seek unbiased information when investing your money. You have been tempted to follow the advice of friends, family, or even certain media outlets. Still, it is essential to stay vigilant and to research any advice you are given before making a decision. Start by looking into the credentials of whoever is giving you advice, and be wary of those who make promises that seem too good to be true. Also, look for research-based sources such as financial experts' reports or independent companies' data. Investing money is a big decision and should not be taken lightly. That's why it is essential to arm yourself with the facts. Only by seeking out unbiased information can you make sure that you are making the best possible decision for your future. Investing can be lucrative to gain money, but only if you make well-informed judgments based on trustworthy and objective sources. Number 3, practice discipline. Staying disciplined and sticking to your investment plan is essential. The best way to do this is to plan by setting a clear strategy and timeline for making decisions and investments. This will help you maintain focus and stay on track with your goals. When emotions start to take over, it can be challenging to make the right decisions. Taking a step back and considering your options calmly and objectively will help you make decisions based on logic rather than impulse. It's also important to remember that the secret to wealth is you've got to start taking steps to achieve your goal with time and patience. Successful people don't become that way overnight. Trying to get rich quickly or taking unnecessary risks in pursuit of a quick return can often result in losses rather than gains. Staying disciplined and sticking to your plan will help ensure that you're making intelligent, informed decisions and building a portfolio that will pay off over the long term. Finally, it's a good idea to have an accountability partner or group of investors who can offer support and guidance when making difficult decisions. A group of people who appreciate the risks and rewards of investing can significantly assist in maintaining discipline and staying on track. Number 4. Consider working with a financial advisor. Working with a financial advisor can help you better manage your investments, especially when emotions come into play. A financial advisor can provide objective guidance, helping you stay on track with your investment plan. They can also help you identify potential risks and opportunities, set realistic goals, and develop strategies tailored to your needs. When selecting a financial advisor, research the company or individual you're considering. Please find out about their credentials, fees, and services. Ask for references from people who have used the advisor before, and make sure to read any agreements carefully before signing them. An experienced financial advisor can provide you with the knowledge, experience, and insights necessary to ensure that your investments remain on track. This type of support can be invaluable when it comes to avoiding the mistake all investors make. If you want to discover how to make money online, to earn more income, to invest more, feel free to click the links down below now. If you want to achieve financial freedom, check out this playlist to discover more. Thanks for watching, and I will see you in the next video.